Whenever we look at a stock in the share market, the very first thing our eyes go to is the price, correct? 200 का है शेयर या 900 का है या ये महंगा लग रहा है, इस तरह के हम डिस्कशन करते हैं. बट लेट मी आस्क यू समथिंग वेरी ऑनेस्टली. डज ए हायर प्राइस ऑलवेज मीन द स्टॉक इज एक्सपेंसिव? थिंक अबाउट इट फॉर अ सेकेंड. Buying a stock by looking only at this price just like buying a car by judging only its color. लाल अच्छा लग रहा है या ब्लैक प्रीमियम लग रहा है तो महंगा होगा, लेकिन ऐसा नहीं होता है. नो, राइट? द रियल क्वेश्चन इज नॉट व्हाट इज द प्राइस. द रियल क्वेश्चन इज दिस स्टॉक इज एक्सपेंसिव और चीप compared to what it earns. And this is exactly where one of the most powerful concepts of the stock market enters the scene. So, the price to earning ratio, or simply the PE ratio. Now, it sounds technical, but I promise you we will understand this in very simple language, step by step. What is PE ratio? In most basic sense, PE ratio tells you how much price you are paying for 1 rupee of company's profit. That's it. Nothing fancy, nothing complicated. If you remember just one line, remember this. PE, price you pay, profit you get. The formula is very simple. Share price earning per share. Let's make this real with an example. Suppose a company share price is rupees 200 and its EPS, meaning the profit per share, is rupees 10. So the PE ratio becomes 200 divided by 10, 20. Now pause for a second. What is the market actually saying? The market is saying, I am ready to pay rupees 20 today for every rupee 1 profit this company is earning. Now comes the most important and most dangerous question. Is paying 20 for rupee 1 profit is too much or too little? Here is the real twist. There is no straight answer. And that is exactly what makes the stock market so interesting and so confusing. There are two commonly used PE ratios, trailing PE and forward PE. Let's start with trailing PE. Trailing PE looks at the past. It uses the earnings of the last 12 months, actually reported profits. The advantage of this is the data is real, no guesswork, no assumptions. But there are problems. The stock market does not run on the past. The price we pay is for the future. If a company's growth slows down tomorrow, trailing PE will react late. That's why relying only on trailing PE can be risky. Now let's flip the coin. Forward PE. Looking into the future. Forward PE uses expected future earnings. This is where optimism, growth, and projection comes in. If forward PE lower than trailing PE, earnings are expected to grow. And if forward PE is higher earning, then earnings might come under pressure. Sounds smart, right? But here is the catch. Forward PE is based on estimates, and estimate can go wrong. Sometimes companies even give conservative guidance just to beat expectations later. A smart investor never trusts just one of these. They study both together. PE becomes even more powerful when you compare it with similar companies in the same industry or with the market indices like Nifty or Sensex. For example, Sensex PE has moved between extreme levels over time. Low of roughly 15.6 in the March 2020 and been as high as 36.21 in Feb 21. From deep fear to extreme optimism. As of Jan 26, the Sensex PE ratio was 23.08. That tells you something very important. PE also reflect market emotions. Fear, greed, hope, excitement, everything is hidden inside that one number. Let's check some real-time example in case of like HDFC Bank, where stock price is 916 and EPS for trailing 12 months is 48.54. So the PE is 916 divided by 48.54, 18.87. So the market is paying almost 19 rupees for every one of HDFC Bank's earning. Is that high or is that low? You won't know unless you compare it. Comparing companies the right way. Now compare this with ICICI Bank. Price 1343, EPS 74.19. So the P comes 18.1. So ICICI trading slightly cheaper than SDFC. What does that mean? Is ICICI undervalued, or does SDFC have better future growth? Or does the market trust SDFC more? This is where analysis begins. But one strict warning, never compare PE across different industries like IT, steel, FMCG or banking, because each has its own growth cycle. So we have to compare apples with apples. You cannot compare apples with oranges. Let me ask you something before we go deeper. Now you know what is P, but when you see a stock with a high P ratio, what comes to your mind first? महंगा है, बबल है, या अभी गिर जाएगा? Many beginners panic when they see a high P. But slow down. A high P ratio usually means one of two things. Either the stock is overvalued or the market expects very high growth in the future. In simple words, investors are saying, we believe this company will earn much more in the coming years. That's why we are ready to pay a higher price today. Think of it like this. Would you pay more for a small tea stall, or would you pay more for a Starbucks outlet at a prime location? The earnings today might look similar, but the future potential is completely different. That future expectations is already built into the price, and that's why P becomes high. But remember, expectations can go wrong, and when expectations breaks, prices fall. Sometimes you also see P shown as NA. Don't panic. What does P NA really mean? It usually means one of the three things. The company is newly listed and hasn't reported earnings yet, like recent IPO companies. Second, the company has zero earnings. And third, the company is currently in loss. It doesn't automatically mean that company is bad. It simply means P cannot be used here. You need to use other tools. Now let's look at very interesting and slightly advanced angle. Earnings yield. Think of earnings yield as the reverse of P. If P is 20, then earnings yield is 5%. What does that mean in simple language? It means for every rupees 100 you invest, the company is earning 5 rupees. Therefore, the reverse angle. So remember this clearly. High P is equal to lower earnings yield, and low P is equal to high earnings yield. This concept feels very similar to bonds yield, and that's exactly why experienced investors love it. Let's make this practical. A stock A, it price 100 and it has EPS of 5. So the P will come 20 and earnings yield will be 5%. And stock B of price 200, EPS 20. So the P will be 200 by 20, 10. And the earnings yield will be 10%. Stock B is giving you more earnings return for the price you pay. However, earnings yield is not as popular as P because equity investors usually focus more on growth, not just current income. Still, when companies have negative earnings yield can sometimes give you another comparison lens. So this is mostly useful where PE is NA as we discussed. Now let's take one step deeper, adding growth to the picture. Sometimes P alone can be misleading. So investor ask a smarter question. What if we compare PE with growth? That's where the PEG ratio comes in. PEG, P earnings growth rate. In simple terms, PEG below 1, it means stock may be reasonably valued or undervalued. And PEG above 1, stock may look expensive. Why PEG more powerful? Because it looks at three things together. price, earnings, and growth. A stock with PE of 30 but growth of 30% might actually be fairly valued, whereas a stock with PE of 15 but growth of only 5% might be expensive. This is why PE is often considered more informative than PE alone. And let's also break PE into two perspectives, absolute PE and relative PE. Absolute PE is simple. It's today, based on current price and current earnings. But relative PE asks a smarter question. How does today's PE compare with its own past? For example, is the stock trading near its 10-year high PE or near its historical low? If the current PE is close to historical highs, expectations are already very high. And if it's near historical lows, either fear is high or opportunity exists. Relative PE helps you understand where you are in the cycle. Now pause here for a second. This part is critical. Like every financial metric, PE has limitations. Very important to understand. It doesn't work well for loss-making companies. It cannot be compared across different industries. It ignores debt. It depends heavily on reported earnings. Two companies may look similar, but the one with higher debt may show lower PE. Not because it's cheap, but because it's riskier. And remember, earnings data comes from the company itself. If earnings quality is poor, PE becomes misleading. That's why never rely on PE alone. When PE fails or PE is not enough, investors use other tools. PB ratio, price to book ratio, or price to sales ratio, PS ratio, or EV EBITDA for capital intensive industries. Each ratio has its own role. There is no one size fits all in investing. Finally, what you should remember, don't fear a stock just because its P is high. Rather, a high P may means high expectations. And don't jump into a stock just because its P is low. It may be low P may the reason behind hidden problems. Because not every expensive looking stock is bad and not every cheap looking stock is good. The real game is understanding valuation. And the PE ratio is one of the most powerful tools to help you play that game wisely, patiently, and intelligently. And most importantly, PE is a lens, not a verdict, a starting point, not a final decision. The market is not just a pricing number, it is pricing hopes, fear, stories, and future dreams. And understanding investor expectations through PE puts you just one step ahead of the crowd. This is how smart investors think. Thank you very much if you are listening till the end. Hope you enjoyed the video and your understanding about the market is deepened